Alrighty, let's do it.
Hey mate, how you going?
I'm very, very good. I am talking to the stars these days.
Yes. So we're going to see if there's any bandwidth issues. Um, and you're connected to Starlink. So explain to me, how does that work? If I'm talking to you, where do the packets go in order to get to me?
The packets are first going 500 kilometers above Earth or something like that. And from there, they probably bounce back somewhere and then reach you. So, yeah, it's pretty
Right.
fascinating stuff.
So for those of you that are new to the series or the podcast, Anirban got a Starlink system set up last week. Was it? It was last week, wasn't it?
Yeah.
There's Siri trying to chime in.
Yeah.
So you got a Starlink last week, and it's been happy days ever since. Like 4K streaming, everything you want it to do.
Yeah, 4K streaming. So, Starlink has really got good stats that they give you. So, we watched a few 4K movies, and you could see like the bandwidth, like the peak data rate for download hitting like 92, 95, 100 megabits per second. It's dumping data. And the reason it dumps data that quickly is because the server side knows that the connection probably has higher latency. So, like our latency jumps around between 25. I've actually seen latency as low as 25 milliseconds, which is pretty fascinating with satellite connectivity. This is low Earth satellite though, but 25 milliseconds to sometimes as high as 100 milliseconds. Now, 100 milliseconds sounds like a lot these days, but it used to be pretty normal, maybe 6-7 years ago. But yeah, given the variability in latency, end-to-end packet transmission, the amount of time it takes to move, actually the packets to move, it is pretty fascinating. So yeah, I've been really pleased with the system thus far. We might, one of the things that might happen is that I might drop out because there might be an outage, because there might be no satellite outage. And most of the time it doesn't matter. But I think for things like Zoom, it might matter. They typically happen for a few seconds. And I haven't had one in the last 24 hours, but most of the time they seem to happen at night. Not sure why.
Interesting. So yeah, right. So this is, for those of you who don't know, this is a subscription where you pay for the hardware as well. So it's kind of like if you bought a new Apple iPhone, you'd have to pay for the iPhone and then pay for the plan. You do the same thing with Starlink. I noticed on your Twitter that it shows you like everything you want to know, like pings, like max rates and stuff like that. So you could see that it was actually bringing forward, like it was buffering, right?
It's buffering. Yeah, it buffers a huge amount of data just up front. And yeah, it gives you, so like if you're connected to the Wi-Fi network, it gives you how much data speed you can get to your, say, mobile device, my iPhone. But it also would calculate how much speed you're getting up to, or data rate you can get up to the Starlink router. Right, because that's where the physical connection is running between the Starlink router and the Starlink dish, just sitting in my room. But I mean, it's just a fascinating piece of technology because satellite internet is supposed to be slow, crummy, really bad. It's satellite internet. There's an NBN provision for satellite internet, like I think it was VSAT or something like that, and that's really crummy. This is just game changer. Like this is basically for anyone who can't get like high-speed broadband, who needs high-speed broadband. This is like happy days. Like, it just makes me smile that this stuff actually works. These things should work, right? So, and the latency being not that big a deal is also pretty great. So, and it should only get better because as the Starlink or SpaceX puts more satellites up there, so hopefully it gets better. So, I've seen my peak download rate is 303 megabits per second. How good is that? 303. Peak upload that I've seen is about 50 Mbps, 45 Mbps, something like that. So it's pretty good. My upload rate is now
stream.
My upload rate is now as much as my download rate used to be. So that's how good it is.
Yeah, I saw a tweet by Tim Urban, which was then retweeted by Starlink, I think, and it basically said that you could be anywhere in the world. You could be in the middle of the ocean with a phone or even just like a computer, a laptop and a Starlink, and you could start a company and run a business, employ people, do whatever you want. And that's kind of the age that we live in. And tools like this are kind of redefining the landscape. Huh? So it's fascinating stuff.
Just to quickly add to this. So one of the things, I wanted this high-speed internet. I didn't have access to high-speed NBN. So if I had access to, say, 100 megabits per second NBN, I would not have considered Starlink. But there's another reason to support Starlink, because the technology is really good. And people who can afford it need to support it to bring the price down. Because I think the real game changer for the world is when this becomes cheap enough that people who don't have access to internet or good internet can actually have great internet. This will change the game. I think this can be a significant value creation for the world in general, because you put the satellites up and you just need a Starlink dish. Just think about places where, rural places where there's no connectivity. This can be a game changer. So I think this is really good for humanity as such. So, one of the reasons I like to support technology that is forward thinking and is going to, the trickle down effect is real. And I think the trickle down effect for this one is fascinating, because, think about this, exactly the same thing. Somebody down somewhere who doesn't have internet tomorrow could actually create the next big company, employ thousands of people. Well, that's great, I think.
It is indeed. So today we're going to talk about some ASX companies. We're also going to hear it from you about. I'm going to pick your brain a bit about some of the key terms of like SaaS metrics, so software as a service, and just generally like the metrics that we use as investors to kind of compile a framework to analyze companies, and how you can use pattern recognition from these ratios to identify companies that should keep on winning. So what are we talking about? We're talking about things like what does ARPU mean? What does dollar-based net retention mean? Why is churn important? These types of things. So we're going to go through them. We've got a few ASX companies that released results this week and either shot it out of the water or they sunk. So they're pretty volatile companies. So we'll take a look at those. Just a reminder, any of the questions that we do answer, if you are on YouTube Live, Robin's already said g'day. Any of the questions that we answer are limited to general information only. So if you want financial advice from a financial planner, like personal advice, you need to go see one of those financial planners. Mate, so we've just talked about Starlink. What have you been working on for Seven Investing?
Well, it's been a busy week. I'm very deep looking into our current recommendations, looking for new ideas, just combing through my watch list. And, it looked like I was going to get the benefit of volatility for November, but then, the stocks went down, then the stocks went up. I mean, how unfortunate is that? So yeah, just researching ideas and just going through my, my watch list. That's been sort of my main focus, other than being excited about Starlink.
Yeah. Hey, did you have to get
What happened?
I think I've, oh, there we go. I think I had a bit of a dropout there. Sorry, mate. So do you, when you pick these companies, you obviously have a list of like 30 companies or something you've said before on your list. How does a company make it from the idea to your list? Do you follow other investors, or what's kind of your principal screening mechanism or getting those ideas there?
Yeah, I don't have a specific mechanism for screening. So like everyone, I would run a screen, what stocks have been going up, what stocks have been going down, what stocks have been growing, quickly, like when going down, I mean, actually share price, sometimes share price movement plus or minus can be indicative of something. So that's a good screen to run. Again, that just gives you a dump of companies. Combine that with, things like which companies are growing quickly, expanding margins and things like that. So those are sort of, I don't do that often, but I do it periodically to just refresh. That gives you a big dump of companies. Then, like, I have a watch list of about 20 odd companies that, I would like to put onto the scorecard, Seven Investing scorecard, for example. And I usually work off that. But then sometimes what will happen is I'll notice a company being talked about on Twitter, or I would notice a news item about a company. Oh, this company went, public recently and yada, yada, yada. And then I'll maybe, look at the 10Q or the S1 if it's a relatively new, recent public company, and have a look and then sort of make an estimate of what I think about it. So, combination of things. But I do land up with some names that people talk about on Twitter. I do find Twitter quite interesting for finding things and
Mm.
discovering things, and for just general chit chat with people and seeing what people are thinking about and talking about. And sometimes what happens is some people are talking about technicals, and technicals don't interest me, but it might actually reveal a company that I wasn't aware of, and then I would have a look. So, and then you sort of have I have quick ways of filtering things. So I'll look at a company and maybe in 10 seconds I'll decide, okay, is it worth further investigation or not, and then go from there. So whole bunch of different things is what I say is how stuff, have a longer watch list, and then it comes to the short list watch list. And yeah, and then of course there's stocks that I own, right? So those are companies that have owned and for a long time. Many of them are on my watch list that I have decided not to add yet for whatever reason. But those are companies again that I follow closely. So
it must help when you have to come up with one recommendation a month, already having 20 to 25 that are, either in your portfolio or really solid companies anyway.
Doesn't help. It doesn't. It's the same problem every month. I find this, I've actually forcing yourself to pick a stock is fascinating. Because if somebody said make a portfolio, I can almost make a portfolio. It's quicker and easier for me to do and say, this will do fine. But I have to pick one stock, and I really do worry about what's going to happen now, what's going to happen soon. A lot of things that I would not worry if I was picking a bunch of stocks together. And I know I could look at the entirety of the stocks that I picked as a bunch and as a portfolio, as a group. But yeah, I just find it's a fact. I've done this for so long, but I still find it difficult. That one stock it's a pretty difficult. It's I struggle with it until I said, okay, that one. And sometimes what happens is once you have said, okay, that one, and then you start, you just convince yourself, yes, it's that one. That's the greatest company right now. And it's the best company right now. And you just are convinced. And, maybe I shouldn't even be saying these things in public, but, but it's true that there is a sense of, once you picked it, it sort of has an overpowering effect. There's a lot of psychological things that go on in people's mind, right? When, the stock picker's mind. So, maybe a little bit of
there is indeed
behind the scenes
confirmation bias as you write it out. It's definitely happened to me once or twice too, I've got to admit. So, and one of the companies that we're going to talk about today is actually maybe one of those companies. So that'll be kind of a bit of intellectual honesty for our viewers and listeners today. We've had a question come through from Robin. He's asked, any thoughts on mining companies that focus on lithium for the future of the EV market? Interesting question. We'll maybe try and tack that on the end there, Robin. So stay tuned. Just in the last week, while you've been playing with Starlink, I've actually been playing with a bit of automation. I just love learning about coding and just new ways of doing things quicker and more efficient. I think there's this skit from Brooklyn Nine-Nine, which is from when there's a new captain on the scene, and he says, "I pride myself on efficiency, efficiency, efficiency." And then someone asks, "Well, why? You could have just said it once." And that's kind of like where I'm at. Like I like things to be really efficient. Like in programming, when you enter some sort of variable or data, you enter it once and then you reuse that throughout your entire program or whatever. And so I kind of approach that when I'm building things and looking at companies and whatever. I think that's a really interesting way to think about companies too, because that is basically like, has the founder or the person who started this put in effort to think about how it scales. And basically there's that saying, I think it comes from Amazon, which is like one step at a time ferociously, or step by step ferociously, which basically means doing the right thing up front, doing it in the order that it should be done, but doing it properly. And so I've been spending my week just doing some of that sort of stuff. We've aired some podcasts with across both of our channels, the Australian Investors Podcast, Australian Finance Podcast. And you'll be pleased to know, mate, we did a bit of a giveaway on the podcast. We like to do one giveaway a month on the Australian Finance Podcast. And this month we gave away last month, I should say, gave away an Apple Watch. Top of the range Apple Watch. And that went to Chanel because she wrote in with her 10 favorite money tips. So it was a bit of fun, and we got to release that podcast with her this week. So that was great. And we also introduced a new thing at Rask. I don't know if you do this. I know you do this in a way at Seven Investing. I just don't know how far it goes, but one of the things that we've tried to do recently in the last few months for our membership service, Rask Invest, is introduce research ratings. So not just investment ratings, but research ratings, where we rate companies across things like the competitive advantage or moat, things like optionality. So how do we think there's embedded value in this organization that people can't see? And things like management, we rate management gold, silver, or bronze. And also things like market dynamics. You can use tools like Porter's Five Forces and think about the industry. And that's basically what we do, but we do it in a qualitative and quantitative way. So it's a bit more organic than using, say, something just straight up like a formula. And we try and introduce these ratings so that our members can understand basically where we see the strengths of these businesses and the opportunity. So it's a new thing. I think Morningstar's been doing it for a very long time. They have moat ratings, they have like star ratings, and many research houses do it. But it's trying to reinforce kind of that qualitative aspect of a business and an investment opportunity, which we think is really important. So we've been working on that. It's taken us months to get around to doing that, but finally we've done it. So yeah, it's been a bit of a busy week. But hey, we're going to talk about some software kind of acronyms, some jumbled up kind of finance alphabet soup, if you like, where we tend to just throw these things around and then expect that people that aren't in finance can understand them. Even things like SaaS. We say SaaS, what does that mean? We have most of us have a pretty basic handle on investing. I remember when I was starting out learning about finance, this was way back in the day, in my teens, I didn't know the difference between earnings and profit. And that is such an innocuous, thing. They're actually the same thing. It's just depending on what you want to, however you want to call it, and however you want to phrase it, whether it's net earnings, whether it's operating earnings, whether it's operating profit after tax, net profit after tax. Like, you've got to just understand these kind of little details. And so we're just going to try and kind of just air the closet on some of these acronyms, and in particular on software companies. So that's kind of both of our areas of focus. So why don't we just start at the top, mate? And I've got to hand it to you. You wrote an article on one of these terms, which we'll get to at the end, and it appeared first in Google when I was trying to find literature on it. So kudos to you. The first thing we might talk about is, we're just going down the list that we've put together. Can you just explain the very basics? So we're going to start at basics, and we're going to make it a little bit harder towards the end. What is revenue, and then what is ARPU?
So revenue is relatively simple. It's just how many dollars you have made in a given period from selling your software, right? It's not how many dollars you have received, but it's how many dollars basically you have booked towards the sale or booked towards the use of your software. The use of your software is important because people tend to pay for software in advance. So we're not talking about that. But yeah, it's how much you can book this quarter or this year or this period for the software that you're typically, in this case, is not selling, but basically people are using, because most of the cloud software would be cloud-based. How do you think I go? Is that all right?
Yeah, I think that's good. And revenue, obviously, it goes across not just the software industry. We have that almost anywhere. What's one really important distinction to make here is when we say revenue, we're not talking about cash flow. So those are two different things. So some people think that when you make revenue, you make cash, but there are many instances, particularly outside of software, like agriculture, for example, where companies earn revenue because they're required to under accounting standards, say, for example, the increase in the value of olive trees or pine plantations, but it's not actual cash flow. It's just accounting revenue. So those are two different things. But for software, I'd say your definition is spot on. How about then ARPU? ARPU is sometimes what we call it. What is
this is a fascinating term that came from the world of telco, right? I mean, ARPU was big in the telco, which is telecom world. ARPU is just average revenue per user. This is relevant because, if you've got the average revenue per user going up, then that's good. That basically means you're selling more, or more is being purchased by your client base. It means you have more modules being sold, or, if it's a usage-based platform, then more people are using it, or they're using more of it. And that's great. Usually, higher ARPU would mean indirectly relate to satisfaction. People are satisfied with what you're offering. They're getting value out of it. They're spending more with you. So that's what ARPU is.
Great definition. I like it. So we like to see ARPU going up because it means that the spend per user on average is going up. Great. Okay. So next one, we're flying through these, which is good, is gross margin. You and I talked about this, gross profit margin, gross margin, and we talked about this a little while ago. And this is typically when people talk about software, they say, oh, it's got high gross margins, and that's a good thing. So can you just explain what that means? This is like moving further down the income statement, right?
Yes. So the gross margin is interesting because gross margin basically would say, there's some cost for making the software, right? Now, that cost is there. There's cost for delivering the software as well, right? So if the software is running on the cloud, then you have cloud infrastructure bills that you're paying for, right? Those would also be for cost of goods. So the cost of goods is going to incorporate that. If you have people delivering customer success, like they're helping the customers understand how to use the software and how to deploy it, so basically acting as consultants, but provided by the company, they would also be part of the cost of goods sold. They'd be incorporated there most of the time. Sometimes they might actually be sitting lower down in the sales and marketing. So this is basically all the direct costs related to provisioning, enabling, and delivering the software, right? Now, the creation of the product or new ideas, that basically sits under R&D, right? It'll be R&D cost. And if people are, helping actually produce new logo wins for customers, and that would be sales and marketing, right? So, or advertising, it'll be sitting under sales and marketing. But yeah, the gross margin would be basically revenue minus costs of goods sold. And there's a little bit of flex in terms of what actually is cost of goods sold for software. As I said, you could move whether customer success should be, how much of it should be in cost of goods sold, how much could be sales and marketing, that is variable, how much of the R&D is the R&D, and how much is actually day-to-day running is also a little bit depends. I think there's enough room there that you can make these judgment calls. So. And then, of course, there's cost for running things on the cloud, which is very easy to understand. That's just the cost.
Yeah, and I think that's a really rounded definition. So basically, on the income statement, you have revenue, which is what we just talked about, minus the cost of goods sold, gives you gross profit, gross margin in dollar terms. Sometimes we express it as a percentage, and we like to see high percentages because that means that there's only a little bit going to that cost of goods sold. The way I think of cost of goods sold and the way I explain it is kind of the unavoidable costs involved in selling. So if there's anything unavoidable, that's basically going to go in there, or at least it should. And then all the other stuff further down the income statement are expenses, and they can be separately kind of broken out for you. So things like R&D and sales and marketing, as you mentioned. Okay, so the reason we're doing these in a very deliberate order because they actually are kind of all building to an understanding of investing in software companies. The next one, which we can put in here, I guess, is churn. Just very basically, what does churn mean when we talk about that in software?
Yeah, and this is for our listeners or people who are viewing this. This list and order was put together by Owen. So he did the hard work of actually making it logically flow like this. Just I had no contribution to this. In fact, I just saw it. I'm coming up with the answers. I didn't even get to prep for this. I should have got some time. This is like quiz. He's like quizzing me here. It's great fun. So churn. Okay, churn is basically. Here's another thing. I wrote about churn. So this stuff, I actually did some analysis. Churn and lifetime value and ARR. These are three things. I actually wrote an article as an advisor update just recently, last week or not too long ago.
All right. Okay.
Back. So I actually quite enjoyed doing this. So churn is just the percentage of customers leaving. Okay. Ideally, you want to describe churn in terms of 100 people. If you have 100 customers and one leaves, then it's 1% churn, right? Retention rate is just 1 minus the churn rate. And that's just churn, customers leaving.
Okay, so you've written this article for 7 Investing, which is actually a free article. It was the first one that appeared in Google. I'm just sharing my screen with you now. While we're here, so we've just discussed churn, which is basically the percentage of customers leaving. And the opposite of that would be retention. So if you have one of every 4 customers leave, that would be a churn of 25%, 1 divided by 4. And if you have the opposite of that would be 75% stay. So that'd be retention. Okay.
Yes.
How about this? Probably the one that we've spoken about a lot recently, which is very important, is dollar-based net retention, DBNR. This is
Yes.
kind of a bit of a step up from the other metrics that we just talked about. But can you, because it relates to churn, I think it's worthwhile explaining. So can you just kind of, as easily as you can, just explain this for us?
Yeah, I think now we are jumping a bit, because one of the things that we could talk about is the relationship between churn and lifetime value, right?
Okay, let's talk about that then. Do you go in the order that makes sense for you and for listeners?
No, I go in the order that Owen told me to go on.
Okay.
So and then we can come back to this. So lifetime value is very simple, right? Lifetime value is actually, you can calculate lifetime value as 1 over 1 minus retention, or 1 over churn rate. Okay, so the lower the churn, so if your churn rate is 1%, then your lifetime value is basically 1 divided by 0.01.
Yep.
Right, which gives you 100. Then so lifetime value basically tells you the average time you expect your customers to stay with you. Now that 100 sounds way too large. Basically, when you've got churn that low, it almost means that customer is going to use your software for as long as your company is going to be around. It seems like that, but it's not quite true, but that's what the math says. The big thing about churn is that if your churn is 50%, then your lifetime value is like really small, right? And if your churn is really low, like 2% or something like that, then your lifetime value is really high. And a lifetime is really high for customers. And that's really good, because the lower the churn, the more you can spend upfront to acquire those customers to have big fat free cash flow down in the future. But if your churn is high, then you really don't have the potential of doing that, because you're spending a lot of money to acquire these people who are just leaking away, right? So it's like a leaky bucket phenomena, right?
So it's like that, that the duck that's swimming across the pond in front of you, and it's wiggling its legs really quickly, but it's only going a certain speed. If you have less churn, it means it's better, because there's more customers staying. So it means you don't have to reacquire the guys and the gals the customers that you got last year. They're still with you. So the new customers that you're getting are just adding to that list, rather than like a sieve kind of just losing them. Yeah. Okay.
Yeah. So leaky, you don't want a leaky bucket. It basically talks to a couple of things. Leaky bucket basically means either your product market fit is not there, or your product is really crappy, or that you don't have your sales and marketing figured out. There is something wrong. It might be that you have a great product, but you're not selling it to the right people. That's again another reason why you have high churn. So just figuring that out is really, really important, and it helps with sort of planning for these long lifetimes, and then sort of enjoying the fruits of those long lifetimes. So the dollar-based net retention, this is the metric that's used quite often, right? Or you can just talk about, it's called just the net retention rate, right? And that's what the article talks about. So, and the interesting thing here is that a lot of companies stopped talking about churn because churn does not tell you on a dollar basis what happened. Whereas the dollar-based net retention basically takes the churn, but also talks about the dollar value of the churn. So if you lose a low value customer, that's okay. If you lose a high value customer, that has a problem. So this example that I had is just a simple fictitious example. At the start, let's say you have four customers, A, B, and C, and D. The first one is $1,000 a year in terms of value that you're going to get out of him for that year. The second also 1,000, the third also 1,000, and the fourth also 1,000. How simple is that? It never works out exactly like that, but it's just an example. In scenario 1, what happens is the customers A, B, and C continue spending exactly the same as they were spending at the beginning. Right?
Think of $1,000 from those first 3. Yep.
Yes. And one of them churned away. Right? Now, what is interesting about this one, though, is this metric, though, that it doesn't capture the fact that actually you had churn of a customer, and your total income at the end of this first period is actually less than that at the beginning, right? If you note in this example. So, because dollar-based net retention, by definition, is looking at those customers that you have left at the end of period 1 compare that with those customers that you had at the beginning of the period, and you're looking at the common customers and how much revenue are you generating from that base. So it's net of churn, it's net of upsell, and net of downsizing, right? Or net of contraction. So net of expansion, net of contraction, and churn. So in this case, your churn actually is 1/4, so 25%, your churn on a customer basis, but your dollar-based net retention is actually 100%. Because those three people that you had, those three people are common across, and they have maintained their sales with you in terms of 100% being 100%. So it basically tells you that those, yes.
So you go on.
No, so basically in this case, for scenario 1, it says that those customers that stay with you, they continue spending the same amount as they were spending last year.
I think the key there is the customers that stay with you, because some customers have left. So we're excluding those that have left. And that's so if you were to look at this, you'd be like, well, I'm only earning $3,000 now, where I was earning $4,000 last year from these customers. Even though my dollar-based net retention is 100% still, it's less. So you've got to, obviously the punchline is here, you've got to use more than one metric. Okay, so what about another scenario? So we've still got, let's say we've got those 4 customers paying $1,000 each at the beginning of the year. Let's do another scenario where at the end of the year, there's a different mix.
This is the scenario 2 that exactly that you talk about on on there, which is, customer A lands up now doubling their spend to 2,000. Customer B increases spend to 1,500, which is 50% more. Customer C, and that should have been seen as a typo there. Oh, I noticed that now. It should be 1,000, and then one of them has churned out. In which case, in this particular case, then in scenario 2, the total spend from those customers that remained has increased by 50%. Right.
So we've got dollar-based net retention of 150%. Even though we've lost one customer, the DBNR is 150% because those that remain on average are paying more.
Exactly. Yeah. So the DBNR is really useful for on a customer basis, on a retention basis, to think about how much more are you able to get from those people that remain with you. Right. And it's one of the metrics that a lot of companies talk about, that on a dollar basis, net of churn, net of expansion, net of contraction, how much am I getting out of my cohort that is staying with me? Right. Ideally, actually, I would like to see both, right. But I mean, you can make out whether, if there's high dollar-based net retention, but revenue is not growing, then you know that something is going on. Right. When you get high, basically you want to see the combination of high dollar-based net retention with revenue growth. And that basically tells you that everything is actually going well. One thing that I'll say, this is the interesting bit, is why I think people talk about DBNR, or basically net retention rate, is this. So think about a company, initially when a company is generating less revenue in total, everything is going to be driven by new logo wins. When new logo, basically new customer wins, right? But think about an early stage business that has DBNR at say 150%, right? It's generating 50% more from those customers that stayed with them, and it is winning new customers at a phenomenal pace. If it can maintain that 50% growth from existing customers, that is phenomenal, because eventually when the business becomes large enough in size, you would generate a lot more from your existing customers. Your existing customers become like this cow that you can continue milking for a long time. And that happens via a couple of different ways, right? Happens because your product expands, or you're able to charge more for your product, or a combination of those things, right? Or because people bought initially few modules and then expanded. They basically bought more of your software over time, right? So a $1 billion business with a net retention rate of 120%, well, that's $200 million just coming from existing customers. That is pretty phenomenal, right? So yeah, and I think that's the key takeaway, and why I think that metric is important.
Yeah, we've talked about it a lot, just insofar as it being like a crucial metric to determine that kind of land and expand types software business model, where they might start with one module. Cloudflare might be a good example. You might get Cloudflare for hosting, but then you realize there's this whole other suite that comes with the Cloudflare platform, and then all of a sudden you're spending more because it's a better service, and you'd switch from your current providers for whatever it might be for security or whatever. And then all of a sudden you're spending more and more and more. And so this is a really powerful one. The other one that gets thrown around a lot, at least here in Australia, and this is probably the fine one. Oh, we've probably got two here. Is this thing called ARR. If I spelled it out for people, I think they'd guess what it is. But what is ARR?
So ARR is just annual recurring revenue, right? So recurring revenue basically is, if you sign up to a subscription, like you have a Netflix subscription or an Amazon Prime, then you know that there's a monthly fee that you're paying, and as long as you're not canceling, that's what you're likely to pay, right? So you look at your customer base and say, well, I've got 100 customers and they're each on average paying this much. Then you take that and you multiply it, and that gives you your annual recurring revenue. It talks nothing about the churn or anything. It gives you at any point in time a snapshot of the revenue that is recurring, right? Of course, you could adapt this to say that, well, this is how much of it I'm likely to retain, and therefore that's the recurring part. But let's just think of it as existing customers that are, paying a subscription fee. You multiply that and you get it. So annual recurring revenue is just that, and ARR is not the same thing as revenue, because you might have picked up a customer, say, in the middle of the year, right? And they're likely to spend, say, $100,000 every year. So your annual recurring revenue is from that customer $100,000, but for that particular year, you might only report $50,000 because you've only used them for half the year. So typically revenue would trail annual recurring revenue. Annual recurring revenue is like a leading indicator. So if annual recurring revenue is growing quickly and the churn rates are low, or there's expansion happening, then you would expect revenue at some point to get to that point of the ARR. It's going to trail. And therefore it can be a leading indicator, and it's kind of useful to get a sense of how quickly the subscription base is growing and how much are they spending.
I've got two questions that have come through here quickly for you. The first one came from Vinoth, who asks, can this metric, as in dollar-based net retention, can this be used to justify a higher price to sales ratio?
Yes, that's brilliant. I love that question. So the beauty is, actually this is an article. Unfortunately, this is actually behind the paywall. So if you can think of this way, I'll just try to work it out here for people. If you've got 50% more that you can generate from your existing base versus somebody who can generate 20% more, now think about that compounded over a large number of years. If you can, so as long as you're bringing in new people into the system and you're able to extract that extra from them over that time, this is pretty powerful. And you'd see that there's a huge divergence. So you would see that the total revenue growth that you can get just by the power of that retained customers growth is phenomenal. And it's indirectly, you can think about it this way: people love you so much that they're willing to spend so much more with you, right? So it's just a power of the platform as well that's being reflected. So yes, I would expect that companies with high DBNRs are appropriately valued as such, right? The only caveat I would say is that if you have a relatively small suite of products that you're offering and you're not a usage-based pricing model, then you could, if your product is that good that everybody buys everything upfront, then your DBNR is naturally going to be low. So you have to think about that as well. But yeah, for certain business, like Snowflake is a great example where the DBNR is like 150, 160%. Like, I mean, there's reason why that stock trades at the multiple it trades, because not many business, and of course it's got usage-based pricing. So it's not really a fixed, seat-based pricing model. So it basically says that people are just using more and more of this thing and people love it, right? And that can really that can just give you phenomenal compounding. So yes, and my rule of thumb is I look for 120%. Like that's just, I like to look for 120%. I'll make allowances here and there, but 120% is really top notch in my view.
Okay, one more question, which is from Robin, who asks, would this metric of dollar-based net retention be easily available on the financial statement of software companies like Xero? I can answer a bit of that and then I'll throw it over. Vinoth says 168 is the current DBNR for Snowflake. So back to Robin's question on Xero. So Xero, if off the top of my head, reports monthly annualized recurring revenue. So what that means is it basically takes the last month's of recurring revenue and then multiplies that by 12. So I guess an example, like Xero is a very stable business in terms of its user base, so its churn's quite low. So it can do this and it's reasonable. But imagine if you had like an ice cream business that sold ice creams on subscription. If they took the recurring revenue figure in February in Australia, when it's really hot and they're selling a lot of ice creams, you might get a different figure for recurring revenue than if you did it in the middle of winter. So that's just an example of how recurring revenue figures can kind of go either way. But DBNR itself, so that was a kind of an example of recurring revenue, but DBNR itself is not as popular in Australia as it is in the US. At least maybe they just don't want to show it as much.
Yeah, so I was going to comment on this. So when I looked at, so one of the things is that here's something to realize, right? So even a DBNR for a business like Xero is actually not going to be very high because it doesn't have significant upsell potential, right? So actually for a business like Xero, really the metric that should matter is just the churn rate, which would be, which would reflect the churn rate you would see of SMBs, right? And as long as it's just that, that's good. Or lower than that, that's great, right? So we have to compensate. So this DBNR metric is really an enterprise SaaS model metric. And by that, I mean companies that sell to other big businesses. It's relevant for that. If you sell to smaller businesses, then a DBNR is a difficult metric to show. And also, if you're a small software company, then how do you really show it? So it's not really shown in Australia, largely because I think the companies that are here are more niche. They have a smaller number of modules. I believe Elmo has at times reported, I think, net retention rate.
Yeah, I think we talked about that. Yeah.
And I think they do report net retention rate. Again, you have to contextualize it that, if you're serving that type of customer base, like small to medium scale customers, then it's going to be different from that you serve enterprise customer bases. So I haven't seen that many, but Elmo is one definitely that reports net retention rates.
Right. And the final one on our kind of list of metrics is customer acquisition cost. So CAC is often how it's written. Can you explain what this is? Maybe how to calculate CAC, and then why?
So CAC is just the cost. This is one of those metrics that I'm actually not a big fan of. Because I don't really pay that much attention to CAC because a lot of times companies actually don't report CAC directly. But so CAC is basically just the cost that it takes to acquire an average customer, which is, net of what you're spending on sales and marketing and things like that to get this, you can compute it. And then you can, of course, use, I guess, CAC became really famous in the startup land because people wanted the CAC to be look at CAC and then look at LTV. So LTV is the lifetime value. Look at CAC and you want that multiple to be like, 4x or more. That sort of became like, the holy grail in the startup land. And if you're like 8x, like lifetime value is 8 times CAC, then, that's great, right? It just basically told you how much more you could spend to get customers. But so I think CAC is useful from that point of view. But I think, I don't use CAC that often. That's just my thing.
Yeah, so customer acquisition cost is basically something that you can get if management break out sales and marketing on the income statement. You can take that and you can divide it by the number of users in the period. If you don't know necessarily, like if they report net users, so if a management team just reports number of net users or the user number is net of churn, then you don't always know exactly how many they acquired versus how many they lost. So you can't get an accurate reading on what is the customer acquisition cost. But if you knew how many customers were added during the period, just added, not lost, so just added, you could take the sales and marketing, divide that by the number of users added to get you basically a cost of acquisition, the cost of adding those users. And this can be I find this can be useful when you're trying to work out if a company is in that kind of rapid adoption phase where it is able to spend the same amount, more or less, but the actual per unit cost is coming way down. And that's kind of a sign that a business might be hitting an inflection point, at least in terms of acquisition of customers. So that's an interesting one. So that kind of rounds out our software metrics. And you said there that you basically.
Can I quickly ask a question? So how would you then adjust I guess you wouldn't in that case, just for because sales and marketing would also include like expansion revenue, right? So sales and marketing is also contributing towards expansion revenue. And if that's not broken down, then it's really hard to know. You kind of have to guess estimate what that well, I guess if you have the DBNR number, then you know how much the expansion revenue is. You take that out, and then you'd have to know how much was the revenue that churned out. So I mean, you have to make some guesses there to get to true CAC, but you can get to a first order CAC via what you said.
Yeah, absolutely. You can just get, and I think the important point is kind of directionally right here. If it's, $10 or $12 for a customer, I don't know what the product is that they're selling, but if it's a $10 customer acquisition cost, and it's now all of a sudden looks like it's heading to $5, well, then that could be something that's really interesting. You may not know perfectly, like customers don't always break out what's customer success versus marketing. Sometimes they do. I think Afterpay for a long time broke out just flat out marketing. So you could potentially do that. Some companies provide it for you, but you just want to check their assumptions. As always, you want to check their assumptions. But in summary here, we've got dollar-based net retention. We've got churn rates are important. We've got total revenue, average annualized recurring revenue. We've got a lot of metrics here, but I guess the key is if you have to go back and listen to this again, we're looking for customers that are spending more, companies that have customers that are spending more, so dollar-based net retention. We're looking for that revenue to be increasing. We're looking for low churn or high retention, depending on which way you want to think about it, and a wide gross margin. Those are just some of the things you want to look for, because those are signs that a business can justify a higher valuation. Okay, so we've gone through this list, and it's taken us a while, but I think it was really valid. We do have some news that we can cover off on here. One of them, the first one, is a company called Bubs Australia, and I'll just get the update up. I'll just make sure I've got the right one in front of me. Here we go. So Bubs Australia is a business that is involved in infant formula, but it's not in the typical way that you would probably think about it. It does goat's milk. So goat's milk, infant formula, goat's milk for adults as well. Full disclosure, I recommended this company quite a while ago, and it subsequently became a sell pretty quickly once things didn't work out. So I held it for a little while, and I think we may have lost a bit of money on this, but so basically, what is Bubs? Bubs was started by a woman by the name of Christy Carr once she realized that her children probably were not necessarily, I don't think they were intolerant to dairy, but they just didn't sit well with their tummies. So she tried goat's milk, and she managed to start kind of this wave of, it's important to have goat's milk, and found out there were some benefits for it for many people. And since it's expanded throughout Australia and globally through China in particular. And it IPO'd, I believe, in 2017. And it's pretty much like, and you'd analyze it in a similar way you'd analyze an A2 milk, which we've talked about in the past, or even a Bellamy's before that. And basically it sells here in Australia, but also overseas. It did rely on that suitcase trade, which we've talked about a bit, going into China. It's since kind of rerouted that a bit. And I don't have a full context of why or how they've done it, but you can see here in the quarterly update, shares jumped 40% in a single day of trading based on this update. So you can see here revenue up 96% for the first quarter of 2021. Infant formula was up 124% or 64% quarter over quarter. Adult goat milk powder increased 100% on the prior year, up 61% quarter over quarter. You can see here that they're off a lower base. They're growing strongly in China. They've also, for those of you that are US listeners, Bubs is now an official Walmart. Walmart is now an official vendor, or Bubs is a product that can be stocked on the shelves, and they expect first online sales this month. So in the month of October 2021 in Walmart. So it's expanding geographically. But principally, this global focus is really important for the business. If we drop down to the cash flow statement, I think we get a sense of basically how big it is. So those numbers look great, and they certainly seem to be, at least the market thinks so. But if you drop down to the cash flow statement for the first quarter, we can see that receipts from customers are 15.2 million or 15.3 million. And we can see $490,000 of net operating cash. So still a small business. It hit a similar inflection point, I think, a year and a half ago, before COVID hit, and things were going well until that point, and then it just couldn't execute, and everything obviously happened to in Australia trying to check trade war, if you like, and then also COVID hitting and constricting that suitcase trade. But Bubs, Bubs is a very interesting business in the sense that it's slightly different to the other providers in the market. It didn't, when I was researching the company, it didn't really get the shelf space that the others got in the stores. So like Aptimal, which almost always sells that here in Australia, at least pre-COVID it did, and A2 Milk for a time there, whereas it seems to be a bit of a role reversal with A2 Milk at the moment, at least in the stores that I've checked out. And Bubs believes that it's the number one selling infant formula over the last few months. So we've all seen what can happen when infant formula companies do well. They can scale very quickly and their cash flow grows kind of exponentially for a pretty short period of time. But it almost seems like sooner or later they're doomed to fail because they rely on sometimes they rely on certain markets or channels that aren't necessarily sustainable and pretty vulnerable to constraints. So, for example, if there's too much inventory in the channel, that operating leverage can quickly turn on a dime. So Bubs is a really interesting business. Like I said, it rose 40% this week. It's not a business that I own. I'll just check the market cap for you. Have you ever owned Bubs, mate?
I did, yeah. I owned Bubs, and I've actually sold my shares some time back as well. So a couple of, and I'll echo some of your comments. So they did a deal with the Chemist Warehouse, or one of those. They had a deal. It was a stock deal, I think. So that gave them shelf space. You're absolutely right when you say that this is one of the things that I've seen with many of these businesses that are still in the phase of creating a big brand for themselves, right? So you have to realize, right, a business with a $15 million of sales in a quarter doesn't have a brand yet. Like, I mean, it has a brand, but it's not Tag Heuer or Louis Vuitton, right? So, that's the ultimate goal, to get to like Tag Heuer, and nobody cares about Tag Heuer these days, I guess, with the Apple Watches, but it's, But anyways, it's not Tag Heuer is my point. So the point is that there is a long gap between that and anything else, right? So the shelf space game is really important. I've seen that with BWX, which makes Sukin and a few other things. You get the shelf space, you've got shelf space really matters. And if you have really small volume sales, you put things on the shelf and that's front and center of people, that sells. Yeah. But then to double the sales from there, you need more shelf space. And that doesn't naturally happen that way. See, at some point you need the brand to really catch on. And I always thought that maybe the A2 brand had caught on, and they were doing sales at scale, right? At the $1 billion scale. And then it's some sort of catered from there. So, I mean, you can get to $1 billion scale and then still cater, which is what the A2 Milk story is. So, I mean, this is a tough gig, right? To create a brand and all, but to your point again, I was quite happy when I had looked at this first and they had this really accelerated sales growth. And the other thing I'll say about Bubs, and this is from past memory about the company, they did a few things well. So their China story is really interesting because they've got Chinese investors. And I think they've got one of the milk company folks from China to also have, I think Beanmate is one of the investors in the company. That helps. Mm-hmm. That helps with distribution. And that helps with having those people help push the distribution. And as long as you can keep pushing the distribution, you can grow.
And that's what they got their Victorian facility. And one of the reasons that they got the Victorian facility was because it was already producing a product that was sold into China, I believe. So yes, it kind of made the approval process for Chinese regulators to approve the facility to then sell into China. Whereas a lot of Australian and New Zealand companies were kind of just saying, come and approve us, here we are, yes, waving their hand, whereas this is already approved. So they've said that they expect growth to continue and they're going to keep ramping up manufacturing. So, I mean, those are positive signs. I just think you just got to go in with your eyes open to the kind of the risks with exporting. And if you do have your eyes open to that, they've got a bit of cash on the balance sheet now. If they can stay cash flow positive, that's obviously great for shareholders. So no more capital raisings. Keep all that in mind. But that's Bubs. It's on the ASX under the ticker code BUB. I guess the reason that I sold was that not just COVID, but there was expansion outside of infant formula and milk. There was talk of all different things at a time when the business wasn't at scale yet. So there were too many things basically saying there's not enough focus. And that was, while it wasn't executing, was an issue for me. The other company that was really interesting this week here in Australia is Netwealth. So we've talked about this company in the past, so I thought it'd be worth bringing it up. I can just share my screen again with you, mate. Once I find it.
This is a company I really, really like. This is a Melbourne-based company and great founders.
Yep.
I have had the chance to speak with the founders, and this is really, really good company. Really solid execution thus far. And look at that. Yep. Record.
So basically, I'll jump to the bottom line first, which is the outlook, which is basically, so Netwealth, for those of you that aren't familiar with it, is a platform, and it basically allows financial advisors and wealth managers and individuals to use a software platform where they can invest, they can manage their portfolios, or the portfolios of their clients, and invest in a range of things like manage funds, ETFs, shares, whatever you can really think of is basically coming on the platform already. So Netwealth is one of the two big new players, which is Hub24 is on the ASX under the ticker code HUB. But down the bottom here in the September quarter business update, they've said, due to record net inflows in the September quarter and the growth of our already substantial new business pipeline, we upgrade our funds under administration net inflow, so the amount of money that's coming onto the platform, for FY22 from $10 billion to approximately 12.5. So it's a 25% increase in what they expect to onboard in the next year, which is pretty substantial. And the reason that's substantial is because so far some people kind of criticize platform businesses for saying, oh, well, that could just be the stock market going up. But actually, not a lot of it is from the stock market going up. So, in the September quarter, they had a $4.8 billion increase in funds under administration, but there's only a $0.8 billion of that from the market movements. So this is Netwealth. It's a really interesting business. NWL, I own shares in this company. You can see here that it's the basic play of Netwealth and Hub24 and Praemium, which is further down, is basically to be better than the current platforms of the big banks here in Australia and to snatch advisors and wealth managers and groups away from those players, which seems to be happening because both Hub and Netwealth are capturing more flow and the incumbents are losing out. So that seems to be playing out, and these guys are going to benefit because they effectively collect annuity-like fees. They're just management fees that just kind of trickle in the door every day of the week. So really interesting business. And it sounds like you like it too.
I love it. It's just one of those very high quality sort of companies that you can find. It's a platform business, right? Once you're on the platform, you're unlikely to migrate, at least in the near term. If your platform is really good, you're going to attract more people onto the platform. And then you're competing against dinosaurs. That's even better. So I love, the ice age is happening, and these things are going to, take over. So
that's
it. It's there's pretty high operating leverage in this business. The EBITDA margins on this company is pretty phenomenal, right? What, 40-50%, 45% plus when I last had looked at it. We have really, really well, good business. It pays a small dividend. I liked it. I don't own shares, but I really like it. And I'd spoken with the senior Heine. Michael Heine. He would not like it if I say Heine. Michael Heine, phenomenal, and phenomenal, very down to earth, and really explains his business, knows his business really well, and and is really long term focused. So I like it.
Yeah, great. Like I said, I own shares, and the shares ended up think it was 14% yesterday. So
But that's
15%
unfair,
over.
right? They're guiding for 25% increase.
Yeah.
And the
Unless it
shares
was
are up
10% overvalued.
Yeah, so the market is basically saying it was 10% overvalued now. All right, okay,
Yeah.
moving on.
Yeah, so that's net wealth. And the final company, which is one we've also talked about before, is Redbubble, the international marketplace for independent artists to upload their art. So you can go back and listen to some of our recent episodes where we talked about this. This is another company I own, and it kind of went the opposite direction yesterday. So the perfect hedge for my net wealth shares going up just about. So Redbubble allows independent artists to upload their designs to the internet or to their platform, and then Redbubble's network of fulfillers allow customers like myself to purchase those things, those designs, put them on, for example, my wall behind me here. I can't, which way am I? This way? No, this way.
No,
And I'll move my head that way.
Yeah.
There it is. Yeah. So that says science. And it's a poster that comes from an Australian artist by the name of Stephen Rhodes. And you get it printed. I want it on a poster, so I got it behind me here. Gets delivered by Redbubble in the fancy wrapping and everything like that. And that's basically the business model. Redbubble takes a clip as orders come through. It collects that cash, it pays some out to the manufacturing company or the fulfiller, and then pays it back to the artist a little while later, their share. So basically, as the business grows, Redbubble has a positive working cash flow flywheel. So as it gets bigger, it collects more cash, and it takes a bit longer to pay that money out. The business has been, quite frankly, smashed since the not that one. This one since the end of COVID in the United States. Basically, the business share price has come back. You can see here from over $6 down to $4.50. And the big reason for that is obviously sales have fallen off when people have returned to physical stores. Sales have fallen off, and they've also they're not benefiting from mask sales. A lot of people want to customize masks and couldn't get any masks at all during COVID. So we can see here gross transaction volume of $142 million during the quarter, down 21%. And in terms of the revenue that they generate, $106 million, down 28%. Gross profit of $42 million, down 34%. Operating cash inflow of $11 million compared to 27 in the first quarter of FY21. Closing cash balance of $109 million, which is pretty good. So why did shares fall, even though everything was in line with guidance? Well, management did say on the call that they made a few things. Obviously, investors don't like to see negatives in the headlines. But one of the things that they did say on the call is that they tried to, experiment with marketing costs, and they spent a bit on marketing during the period. If we drop down to it, and I credit companies with experimenting to try and improve their business model, especially when they have enough cash in the balance sheet. But basically, marketing costs were still pretty high as a percentage of marketplace revenue, and so I think maybe investors didn't like that. I'm only speculating. You can only speculate on short-term price movements, but I think maybe investors didn't like that. They've said that will normalize in time. And for those of you that don't understand the advertising ecosystem lately, there have been some changes from Apple, obviously with iOS 14 changing the way that retargeting happens. So that affects the marketing ROI of many companies like Redbubble. So here we are, Redbubble spending a bit more. It's guiding for a negative year over year first half as it cycles through COVID comps. But then returning to growth. They've got an aspirational target for the long term, which I don't necessarily think they'll deliver on. Our valuation model does not assume that they will meet their 2024 calendar year guidance, or at least aspirational target. So yeah, Redbubble, it competes against Etsy, Amazon Homemade, maybe even things like Canva in the future. So it's got some pretty big competition, some pretty big headwinds. But I still think the business itself is in a good position, and I think it's well led. So yeah, that's Redbubble. Fell, what did it fall? 12% yesterday. So that wasn't very nice, but that happens in investing.
It's not too bad. 12% is nothing. It's like small potatoes.
That's the what's the price for admission? Is that right?
Exactly.
Yeah. No, that's Redbubble. It's interesting business. So the three interesting businesses there, all kind of small to mid cap in Australia here. Well, Netwealth's pretty big now. So three to pop on your watch list. Mate, we've gone a little bit over time, but that's okay. If people want to subscribe to Seven Investing, I'm guessing they can go to seveninvesting.com/subscribe. And there's a link in the show notes for anyone that wants to subscribe and get your latest and greatest, potentially, stock idea.
Yeah, use the RASK code, RASK, get $10 off your first month. Yeah, the latest and the greatest, the best, whatever not, well, we'll see whether or not it's the best. Time will tell.
We'll find out in 5 years.
We'll find out in 5 years. Right now, the picks are doing okay.
Yeah, no, they're doing very, very well. And as always, you can find us on Twitter at 7A Mohanty for Dr. Anirban Mohanty here, and at Owen Rask, also in the show notes. You can find us there and have a chat. Give us some ideas for next week. We've had Vinoth and Robert ask some questions today via the live chat. We'll be back next week, so you can ask us some questions then. And we look forward to seeing you. So, mate, as always, it's been a pleasure. Thanks for joining me. This connection was brilliant.
So Starlink is awesome. Yeah, and these chats, I love these chats, doing these with you. And it's fantastic actually having some people come by online, ask us questions live, throw some curveballs at us, make it difficult for us, or make it difficult for Owen, not for me, please. I didn't even get to prepare. But yeah, and ask us about any particular companies you want us to talk about, stuff like that.
Yep. We just had Mickey just put in a question. Everyone has owned bubs at some point. Maybe they'll become the GOAT of the infant milk market.
I love it. Love it. Yeah. I really had, and I think bubs could still execute, right? I mean, it can still execute. It's got a niche. GOAT. It's GOAT.
Yeah. And Robin did ask a question earlier on to say on the mining companies that focus on lithium.
Yes.
Neither of us, I think I speak on behalf of us, neither of us are big in mining. But if you do want a short list of companies that are involved in lithium, here in Australia, what you can do is you can head to, you can find an ETF like the ACDC ETF that focuses on this sector, and then you can go to the ETF Securities website and find the list of companies that are in that index. It's a great way to do it. Okay. Always a pleasure, guys. Thank you so much for joining us, and we'll see you next week. Thank you so much.